What is the difference between a traditional line of credit and a reverse mortgage? This is Mike Banner, and welcome to the Reverse Mortgage Planet. What is the difference between a traditional home equity line of credit, a HELOC, and a reverse mortgage? It's a good question, and I'm going to give you several different answers right now. Number one, in a traditional home equity line of credit, the biggest answer would be there are payments to be made. You always must make payments. Sometimes they're low payments, sometimes they're not, but every month you have an obligation of making a payment. With a reverse mortgage line of credit, you do not have that obligation of making a monthly payment ever. You can, something you have to remember, you actually can make a payment, but you don't have to. Number two, with your home equity line of credit, your HELOC, you are subject to losing that line of credit or having it decreased at any moment in time. No matter how good of a client you are, I'm sure you know or have neighbors or have many, many friends that during the Great Recession from 2009 through 2013, as values of homes were coming down, not thousands, not tens of thousands, but hundreds of thousands of people that had lines of credit were getting letters from their bank saying, I'm sorry, due to the value of your home decreasing, we are decreasing your line of credit. That can never happen in a reverse mortgage line of credit. A reverse mortgage line of credit is a contractual obligation between you and HUD for a certain amount. And whether your house goes up in value or down, they can never, ever decrease that value. Number third, incredible reason is, in fact, you have to qualify for a home equity line of credit if you'd like to increase it from the original amount. You go back into your bank with tax returns, bank statements, they run another credit report. In the reverse mortgage line of credit, it has a built-in growth factor. I like to refer to it as a hedge against inflation. But every year in your reverse mortgage line of credit, your unused portion of your line of credit goes up by a formula. And it's a simple formula. That formula is your cost of your money, your interest rate, plus a half a point. So let's just say your interest rate was 4.5, and at the end of the first year, you had $100,000 remaining in your line of credit. It would increase your availability of funds by your cost of funds, 4.5, plus a half a point. That would be 5. So your $100,000 line of credit would automatically be increased to $105,000. Let's give you one more example. If you had an unused portion of a $200,000 line of credit and your interest rate was 4.5, plus a half is 5, your $200,000 line of credit would go up to $10,000, $210,000 in total. A built-in inflation hedge that allows your unused portion of your line of credit to keep going. That is probably, other than no monthly payment obligation, the biggest difference between a traditional line of credit and a reverse mortgage. Thank you for joining us. As always, if you need more information, please contact me at mbanner@thereverseplanet.com, or if you're interested in applying for a reverse mortgage today, click on the link below.